All right, hey everyone, welcome in. We're diving deep today into something you all flagged as super important, a document that's, well, it's basically the auditor's guide to dealing with fraud.
Yeah, we're talking ISA 240, the auditor's responsibilities relating to fraud in an audit of financial statements.
That's the one. And look, we know these standards can be a bit dense, a bit overwhelming to try and read through the whole thing.
Right.
So what we want to do is give you the need to know, the critical stuff from ISA 240 about how auditors are supposed to handle fraud when they're checking out a company's financial statements. Like, what are their duties? What
Wow.
should they be on the lookout for? All that good stuff.
Absolutely, yeah. So think of this as your shortcut to understanding the key parts of ISA 240 without getting bogged down in the legal jargon.
Exactly. Now, just so we're all on the same page, ISA 240 has been the rule of the land, so to speak, for audits of financial statements for periods starting on or after December 15, 2009.
Right. It's important to remember that ISA 240 doesn't stand alone, though. To really get the full picture, you need to read it alongside IS 200.
Overall objectives of the independent auditor and the conduct of an audit in accordance with international standards on auditing, right?
Yeah, exactly. So ISA 200 kind of sets the big picture goals for any independent audit, and then ISA 240 hones in specifically on the auditor's role when it comes to potential fraud.
Okay. So let's jump right into ISA 240 and what it actually tells us. First things first, how does it define fraud in the context of financial statements?
Well, ISA 240 says that fraud, when we're talking about financial statements, means an intentional act
Okay.
by one or more people, and those people could be management, those charged with governance, employees, or even third parties.
Right.
And this act involves using deception to gain an unjust or illegal advantage.
So the key here is that it's intentional, right?
Exactly. That's the big difference between fraud and an error.
Right. Because an error is unintentional. So how can an auditor tell the difference between something that's deliberate, like fraud, and something that was just an honest mistake?
That's a great question, and it's one of the trickiest things for auditors to figure out.
Right.
Because errors, those can happen for a variety of reasons. It could be a simple calculation mistake. Maybe someone overlooked something, just a slip up.
Right.
But fraud, because it's intentional, it often involves some effort to hide it.
Oh, I see. Yeah.
So we're talking forged documents, deliberately omitting important information, or maybe even intentionally misapplying accounting principles.
Okay, so the auditor has to be looking for those like more subtle red flags.
Absolutely.
Now, fraud itself, it sounds like it's not all the same, right? I mean, the standard mentions different types.
Yeah, you're right. ISA 240 points out two major types of fraud that auditors need to be aware of. We've
Okay.
got fraudulent financial reporting, and we've got misappropriation of assets.
All right, break those down for us. What's the difference?
So fraudulent financial reporting, that's when someone intentionally cooks the books, essentially.
Okay.
They're messing with the numbers in the financial statements, maybe to make the company look more profitable than it really is, or to hide losses, or to make their financial position look better to investors or lenders.
Right, so it's all about manipulating the perception of the company's finances.
Exactly. Now, misappropriation of assets, this is more about straight up theft.
Okay.
This is where someone steals or misuses the company's resources for their own personal gain.
Got it. So that could be anything from pocketing cash to using company property for personal use or even stealing inventory.
Right, so one type is about manipulating the information and the other is about taking the stuff.
So those are the two main flavors of fraud that auditors are dealing with. Now, whose job is it to actually prevent and detect fraud in the first place? I mean, is that all on the auditor?
That's an important point. While the auditor plays a crucial role in looking for fraud, the primary responsibility actually lies with the company's management and those charged with governance, like the board of directors.
Okay.
They're the ones who need to set the ethical tone at the top and put strong internal controls in place.
Right. The systems and procedures that are supposed to prevent fraud from happening in the first place or catch it quickly if it does.
Exactly. So you can think of them as the first line of defense.
Okay. So if they're the first line of defense, what exactly is the auditor's role in all of this?
Well, ISA 240 lays out the auditor's objective. It's to obtain reasonable assurance that the financial statements as a whole are free from material misstatement.
Okay.
Now, that means whether the misstatement is due to fraud or error. And notice, it says reasonable assurance, not absolute assurance.
Right, right.
Auditors can't guarantee that there's absolutely no fraud. An audit is designed to provide high, but not absolute assurance because of the inherent limitations of the audit process. There's always a chance that something could slip through the cracks, especially if it's a really sophisticated fraud.
Okay, so that makes sense. It's about reducing the risk, not eliminating it entirely.
Exactly.
Now, something I've always heard about auditing, especially when we're talking about fraud, is this idea of professional skepticism.
Right.
What exactly does that mean for an auditor out there in the field?
Professional skepticism is huge. It's like the foundation of how an auditor has to approach their work. It essentially means having a questioning mind, not taking things at face value, and being alert to anything that could suggest the financial statements might be misstated, whether that's due to an error or, more importantly, fraud.
Okay, so they can't just assume that everything management is telling them is true, right?
Right. And they also can't go in assuming that everyone is trying to deceive them.
Yeah, it's about finding that balance.
Exactly. It's about thinking critically, looking for inconsistencies, things
Yeah.
that don't quite add up, or information that seems, a little too good to be true.
Right. And they have to be prepared to dig deeper, right?
Yeah.
To challenge assumptions and not just accept documents or explanations at face value.
Exactly. They need to scrutinize everything, especially the reliability of documents and any responses they get from management. And a big part of professional skepticism is being comfortable with doubt, questioning whether the information they're getting is really as reliable as it seems.
It sounds like a lot of this comes down to the mindset of the auditor, being willing to question and challenge.
Absolutely.
Now, does ISA 240 say anything about how the audit team itself should communicate and work together when it comes to the possibility of fraud?
It does. ISA 240 specifically requires the audit team to have a discussion about how susceptible the company's financial statements might be to material misstatement because of fraud. This is a chance for them to brainstorm, how could fraud happen here? What are the weak spots? What should we be paying extra attention to?
Right, so it's like a brainstorming session to try and anticipate where the risks might be.
Yeah. And during that discussion, the team has to set aside any preconceived notions about management's honesty.
Oh, I see. So even if they've worked with the company for a while and have a good relationship with management, they can't let that influence their judgment about potential fraud risks.
Exactly.
That makes sense. So once they've had this discussion, what are the actual things that auditors do to try and identify and assess those fraud risks?
Well, they start by performing what we call risk assessment procedures. These are designed to gather information about the company, its environment, its internal controls, and anything else that can help the auditors understand where the risks of material misstatement due to fraud might be higher.
Okay, so what do those procedures actually look like? What are the auditors doing?
They're doing a few key things. One is making inquiries. They'll talk to management, they'll talk to other people within the company to try and get a feel for the company's culture, its attitude towards fraud, its internal control environment, things like that.
So what sorts of questions would they ask management specifically when they're trying to understand fraud risks?
They'll ask management things like, how do you assess the risk of fraud in your company? What processes do you have to identify and respond to fraud risks? How do you communicate the importance of ethical behavior to your employees? Things like that. They'll also specifically ask, are you aware of any actual or suspected fraud within the company?
Right, so they're really trying to get inside management's head and understand how they're thinking about fraud.
Exactly. Another thing auditors do is perform analytical procedures.
Okay, tell us about those.
Analytical procedures are all about looking at the numbers, looking for patterns or relationships that seem unusual or unexpected.
Okay.
Because those unusual patterns or relationships, those could be red flags that something fishy is going on.
Right, like maybe there's a sudden spike in revenue, but it's not accompanied by a corresponding increase in expenses.
Exactly, something like that. It's about using data analysis to look for anything that seems out of the ordinary.
So once the auditors have gathered all this information, how do they actually pinpoint the specific areas where fraud might be a bigger risk?
Well, ISA 240 requires auditors to identify and assess fraud risks at two levels, at the financial statement level and at the assertion level.
Okay, what's the difference?
So at the financial statement level, they're thinking about risks that could affect the financial statements as a whole.
Right.
And then at the assertion level, they're zeroing in on specific claims made in the financial statements.
Oh, I see.
For example, an assertion might be that the company's inventory is valued at a certain amount. So at the assertion level, the auditor would be assessing the risk that that specific claim about inventory might be misstated because of fraud.
Okay, that makes sense. It's like they're zooming in from the big picture to the individual
Right.
details. Now, I remember reading something about a presumed fraud risk, specifically related to revenue recognition. What's that all about?
Yeah, ISA 240 acknowledges that revenue recognition is often a high-risk area for fraud
Why is that?
because revenue is such a key metric for companies. There's a lot of pressure to meet revenue targets, and it can be tempting to manipulate revenue figures to make things look better than they are.
Oh, I see. So the standard is saying basically, hey, auditors, keep a close eye on revenue recognition because it's an area where fraud is more likely to happen.
Exactly.
And what about fraud risk factors? What role do those play in the auditor's risk assessment?
Fraud risk factors are like warning signs or clues.
Okay.
They're events or conditions that could indicate that there's an incentive or pressure to commit fraud, or an opportunity to commit fraud, or an attitude or rationalization that would allow someone to justify committing fraud.
So it's like those three elements of a crime, right?
Yeah.
You've got the motive, the means, and the opportunity.
Yeah, that's a good way to think about it. And Appendix 1 of ISA 240 actually provides a whole bunch of examples of fraud risk factors broken down into those three categories: incentives, pressures, opportunities, and attitudes rationalization.
Okay, so can you give us some specific examples?
Sure. So, an example of an incentive or pressure might be a company that's facing financial difficulties. They're really struggling to meet their financial targets.
Right.
That pressure could create an incentive for someone to cook the
You
books.
need to make things look better than they are.
Exactly. An example of an opportunity might be weak internal controls. If the company doesn't have strong procedures in place to safeguard its assets or to ensure the accuracy of its financial reporting, that creates an opportunity for someone to commit fraud.
Right, it's like leaving the door wide open.
Yeah, exactly. And an example of an attitude or rationalization might be, let's say, a management team that doesn't really seem to care about ethical behavior. Maybe they bend the rules a lot, they cut corners, they're always looking for ways to get around the system.
So they might be more likely to rationalize fraudulent behavior as no big deal or everyone does it.
Exactly. They might not see it as truly wrong.
Right. Okay, so the auditors are looking for those red flags, those
Right.
risk factors. Once they've assessed the risks, what do they do with that information? How does it actually affect the audit work they perform?
Well, ISA 240 says the auditor has to determine what we call overall responses to address the assessed risks at the financial statement level.
Okay.
These are broad actions they take that can influence the whole audit.
So what kind of things are we talking about?
Well, for example, if they've identified a high risk of fraud in a particular area, they might assign more experienced staff to that area.
Okay.
They might increase the level of supervision over the audit team, make sure everyone's dotting their I's and crossing their T's.
Makes sense.
They might incorporate more unpredictability into their audit procedures.
Oh, that's interesting. What does that mean?
Well, it means not being predictable in their approach.
Right.
So instead of always testing the same controls at the same time every year, they might switch things up, do things at different times, maybe even do some things without giving the company any advance notice.
So they're keeping everyone on their toes, making it harder for anyone to anticipate what the auditors are going to do.
Exactly. The goal is to make it harder for someone who's thinking about committing fraud to be able to predict what the auditors will be looking at and to be able to cover their tracks.
So smart.
Now, in addition to these overall responses, the auditor also has to design and perform specific audit procedures to address the risks that they've identified at the assertion level.
Right. Those specific claims about account balances, transactions, and disclosures.
Exactly. So, for example, if they've identified a higher risk of fraud related to the valuation of inventory, they'll design procedures that are specifically targeted at examining inventory values in more detail.
Okay, so the nature, the timing, the extent of their procedures, all of that is going to be adjusted based on the level of risk they've assessed.
Well-
Now, one thing that seems particularly worrisome when it comes to fraud is the possibility of management override of controls. How does ISA 240 address that risk specifically?
Yeah, management override is a big one because even if a company has really great internal controls in place, those controls can be bypassed by someone who's in a position of authority.
Right, someone who knows how the system works and can find ways to work around it.
Exactly. So to deal with that risk, ISA 240 requires auditors to perform specific procedures that are designed to detect management override.
Okay, like what?
Well, for example, they'll scrutinize journal entries and other adjustments, looking for anything that seems unusual or suspicious.
Okay.
They'll review accounting estimates, looking for any signs of bias that might suggest that someone's trying to manipulate the numbers.
Right. They're looking for those subjective judgments that might have been skewed in one direction or the other.
Exactly. And they'll evaluate the business rationale for any significant or unusual transactions that might not have a clear business purpose.
So if something seems out of place or doesn't make sense from a business perspective, that's a red flag that needs further investigation.
Exactly.
Now, as the audit is going on, the auditors are obviously gathering a lot of evidence. How do they use that evidence to evaluate whether their initial assessment of fraud risk was accurate?
Well, throughout the audit, the auditor has to constantly be thinking about whether the evidence they're gathering supports or contradicts their initial assessment of fraud risk. And near the end of the audit, they'll specifically evaluate whether the analytical procedures they've performed and all the other evidence they've accumulated is consistent with the risks they identified earlier.
Right, so it's like a constant process of reassessment. They're always asking themselves, does this evidence support what we thought, or does it suggest that we need to adjust our thinking?
Exactly.
And what happens if they actually find a misstatement? How do they go about figuring out whether it's just an error or if it's something more deliberate, like fraud?
Well, if they find a misstatement, they have to carefully consider all the circumstances, the nature of the misstatement, how it happened, whether there are any signs that it was intentional. And if they suspect fraud, they might need to do more work to investigate further.
Okay, and what if it gets to a point where the auditor just doesn't feel comfortable continuing the audit engagement? Does ISA 240 have anything to say about that?
It does. There are certain circumstances where the auditor might decide that it's not possible to continue the audit.
Like what?
Well, one scenario would be if they have serious concerns about the integrity of management or those charged with governance.
Right, if they just don't trust that management is being honest and ethical.
Exactly. Another scenario might be if they encounter conditions that make them think that management isn't cooperating with the audit.
Okay. So if they're being stonewalled or if they feel like they're not getting the information they need, they might decide to walk away.
Exactly. In those cases, the auditor would have to consider their professional and legal obligations, and that might include resigning from the audit.
And communication seems like it'd be really important in those situations. Who does the auditor need to talk to if they suspect fraud?
Absolutely. ISA 240 is very clear about the auditor's responsibility to communicate. They have to communicate any fraud or suspected fraud to management and to those charged with governance.
Okay.
And they also need to talk to them about their overall assessment of fraud risks and the company's internal controls.
Right. So it's not just about reporting specific instances of fraud, but also about having those broader conversations about the company's overall fraud risk profile.
Exactly.
Now, are there ever situations where the auditor might be required to report fraud to someone outside of the company?
Yeah, in some cases, depending on the laws and regulations of the jurisdiction, the auditor might have a legal or regulatory obligation to report fraud to an outside authority, like a regulator or law enforcement agency.
Okay.
So that's something they'd have to consider carefully.
It's a lot of responsibility.
It is.
And I imagine documentation is really important in all of this, given how sensitive the topic of fraud is. What are the key things that an auditor needs to document related to fraud?
Documentation is absolutely crucial. ISA 240 says that the auditor needs to document the significant decisions they made during the audit team's discussion about fraud risks.
Okay.
The specific fraud risks they identified, both at the financial statement level and the assertion level,
Right.
their responses to those risks, the audit procedures they performed, the evidence they gathered, and they need to document any instances of fraud or suspected fraud that they communicated to management, those charged with governance, or anyone else.
Okay, so it's a comprehensive record of their entire thought process and all the steps they took related to fraud.
Exactly.
Now, ISA 240 also includes a few appendices that provide some additional helpful guidance. Can you give us a quick rundown of what those cover?
Yeah, so Appendix 1 provides more examples of fraud risk factors.
Okay, those red flags we talked about.
Exactly. And it breaks them down into those same three categories: incentives pressures, opportunities, and attitudes rationalization.
Okay,
So it gives auditors a lot of specific things to be on the lookout for.
got it. What about Appendix 2?
Appendix 2 gives examples of audit procedures that auditors might perform to address the assessed risks of material misstatement due to fraud at the assertion level.
Okay, so it's like a toolkit of specific procedures that auditors can use.
Yeah, that's a good way to think about it. And it breaks down the procedures by different areas like revenue recognition, inventory, management estimates, things like that.
Right, so it helps auditors tailor their procedures to the specific risks they've identified in those areas.
Exactly.
And lastly, Appendix 3. What does that one cover?
Appendix 3 gives examples of circumstances that might indicate the possibility of fraud.
Okay.
So these are things that, if the auditor sees them, should really raise their suspicions and make them think, this could be a sign of fraud.
Right, so it's like a checklist of red flags to watch out for.
Exactly. And it covers things like discrepancies in the accounting records, conflicting or missing evidence, and problematic or unusual relationships between the auditor and management.
Okay, so it's a really helpful resource for auditors to have as they're going through the audit process.
Absolutely.
Well, I think this has been a super informative deep dive into ISA 240. It's clear that the auditor's role in addressing fraud is really critical, and it requires a lot of skill, judgment, and a healthy dose of skepticism. Thanks for walking us through it.
My pleasure. It's been great to talk about this important topic.
And for you, our listeners, as you think about all of this, I want to encourage you to consider how the principles of professional skepticism that we've talked about today might apply in other areas of your life.
Right.
How do you balance trust with critical evaluation when you're reading the news, when you're making important decisions, even when you're just navigating everyday situations? It's a valuable skill to have, to be able to think critically and not just accept everything at face value.
Yeah, definitely. Food for thought for everyone.
Absolutely. Thanks again for joining us for this deep dive, and we'll see you next time.
See you next time.